If you have gone through a divorce, or you know someone who has, you know how difficult it can be. Dividing up assets and liabilities is a big part of the process. After the divorce is finalized, what you may not realize is that even though you, your ex, and the court have all agreed that your joint responsibilities are now the responsibilities of just one of you, the lender may not see it that way. My name is Jonathan Getty with Catalyst Lending. Today, I want to educate you on the dangers to your credit after a divorce and how you can protect yourself.
A divorce decree is the legal document that signifies the end of a union and confirms how the assets, but also the liabilities, of the parties will be divided. In the divorce decree, there are usually several items that are now the responsibility of just one of you that are joint accounts, meaning you both applied for the account. While that mortgage payment, car loan, or credit card may now be the responsibility of your ex, your credit is still on the line. When you applied for the account, the creditor used the combined risk of lending to both you and your spouse to determine whether to extend you the credit you requested. While the divorce decree may say the account is no longer your responsibility, at no point has the creditor agreed to release either of you from the obligation to repay the debt. It is your responsibility to speak to each creditor and have them confirm for you, in writing, that they are releasing you from the obligation. If your liability is not released from the obligation, any missed payments, defaults, or collection accounts will be reported on your credit. Many creditors will not simply remove you from financial responsibility. In this case, paying off the debt and having your name removed or closing the account to prevent future changes is the only way to protect your credit. In the case of a mortgage loan, often the only way to get a release from liability is for the responsible party to refinance the loan in his or her name. Remember, when you co-sign for a loan or jointly apply for financing, whether with your spouse, your friend, your child, or your colleague, you are personally guaranteeing repayment of that debt, and the payment history, balance, and any default will affect your credit as if it were your own. The only way to protect your credit is for the creditor to agree to remove you from the account or to pay it off and close it. For other simple tips for better credit, go to our website, where you can also pull your own full 3-bureau credit report, sign up for a free consultation, or apply for a mortgage. www.catalystlending.com/credit.